US stock market just sent a signal that most investors are overlooking, but this signal may shape the next major move on Wall Street. If you've been watching the market closely, you may have noticed a strange shift in the last 24 hours. Tech stocks paused, bond yields moved against expectations, and institutional traders quietly adjusted their positions. These changes are not random. They are happening because the market is preparing for something significant. The Federal Reserve's next major decision, and what happens next could influence your portfolio more than any single event this month. Stay with me, because by the end of this video, you will understand exactly what this signal means and why so many experienced traders are suddenly paying attention. Before we go deeper, if you want daily US stock market breakdowns without the complexity, make sure you subscribe to Wall Street Market Brief. This channel delivers fast, clear, and professional updates that help you stay ahead of market-moving events. Now, let's get into today's shift. The first sign that something unusual is happening came from the bond market. Treasury yields dipped despite stronger economic data, something that usually does not happen. When yields drop while economic reports stay firm, it often means investors are expecting the Federal Reserve to adjust its tone or are preparing for a potential change in policy direction. This kind of move suggests uncertainty, and uncertainty almost always leads to higher volatility in the days ahead. The second signal came from the tech sector. For the past several weeks, mega-cap tech stocks have been powering most of the market's strength, but today, that momentum slowed. Apple, Microsoft, Tesla, and even Nvidia saw reduced buying pressure. When the biggest drivers of the market lose steam at the same time, it usually means investors are becoming cautious. Tech stocks are highly sensitive to interest rates, so any uncertainty around the Fed leads to hesitation. This pause is not panic, but it is a warning that something is shifting beneath the surface. At the same time, smaller companies started seeing more activity. Small-cap stocks typically rise when investors expect interest rates to move lower or when they anticipate a softer tone from the Federal Reserve. That trend indicates a potential rotation, where money begins to move out of large tech names and into sectors that benefit from lower borrowing costs. These early rotations often appear days before major market moves. The third major signal came from options traders. Over the last day, volatility pricing increased, even though no major economic report was released. When options traders price in higher volatility without a clear catalyst, it means they expect the market to react strongly to something that has not yet happened. In this case, that something is the upcoming Fed decision. Institutional traders are preparing for a wider range of outcomes, suggesting that the Fed's next move may not be as predictable as investors hope. Another factor influencing the market is inflation data. While certain categories like goods and manufacturing inputs have cooled, services inflation remains stubborn. This makes the Fed's decision significantly harder. If inflation remains above target, the Fed cannot ease policy aggressively. But if economic activity slows too much, they risk tightening financial conditions at the wrong time. This delicate balance is exactly why traders are moving cautiously and adjusting their positions ahead of the decision. Corporate earnings are also playing an important role. Some major companies reported solid results, but others signaled pressure from rising costs and slower consumer demand. Mixed earnings create additional uncertainty, and uncertainty does not sit well with institutional investors. When earnings do not point clearly in one direction, investors naturally turn their attention to the Federal Reserve for clarity. Here is what most investors do not realize. The market does not usually react the most on the day of the Fed announcement. It reacts before the announcement and immediately after the press conference, when the Fed's message becomes clear. The biggest volatility spikes occur during those moments, not during the long-term trend. The smartest investors position themselves early, not after the news is released. So what happens next? If the Fed signals that inflation is under control and that rate cuts are possible in the future, tech stocks could rally again, yields could drop further, and the broader market may rise as confidence returns. But if the Fed warns that inflation remains too high or that more tightening is possible, tech stocks could fall sharply, defensive sectors could rise, and small caps may lose the momentum they have just started to gain. The direction is uncertain, but the coming movement is almost guaranteed. This is why today's signals matter. The bond market, tech sector, small caps, and options pricing are all reacting ahead of the Federal Reserve. These early signals do not predict the exact outcome, but they do indicate that the market expects something bigger than usual. And when the market expects something big, volatility almost always follows. If you want to stay ahead of these shifts and understand what the market is preparing for, now is the perfect time to subscribe to Wall Street Market Brief every day. We break down the most important US stock market developments in a simple, clear, and professional way, helping you make smarter decisions no matter what the market does next. And if you want a follow-up video where I analyze the potential scenarios after the Fed announcement and how each one could impact major sectors, let me know in the comments. For now, keep an eye on yields, watch tech behavior closely, and pay attention to how investors position themselves in the next 48 hours. The market rarely stays quiet before a major event, and this time, the signal suggests that a significant move is coming.